In 1963, banks and trading firms believed one company controlled enormous reserves of vegetable oil. The company was Allied Crude Vegetable Oil. Its warehouses were reported to contain millions of dollars in valuable commodity inventory. Banks accepted that inventory as collateral for large loans. Warehouse inspectors verified the tanks. Storage receipts confirmed the quantities. On paper, the tanks appeared full of oil. Financial institutions relied on those documents to extend credit. The company's borrowing capacity expanded rapidly. Lenders assumed the collateral was secure. But inside many of the storage tanks, most of the volume was not oil. The tanks were largely filled with water. Only a thin layer of vegetable oil floated on the surface. Inspectors measuring the surface level believed the tanks contained far more oil than they actually did. The documentation appeared legitimate. The collateral appeared verified. For a time, the system functioned without challenge. But when auditors began examining the tanks more closely, the illusion collapsed. The inventory that supported millions in loans barely existed. This was the Great Salad Oil Scandal. During the early 1960s, global demand for vegetable oils increased steadily. Vegetable oil was widely used in food processing, cooking products, and industrial applications. The United States became a major participant in the global vegetable oil trade. Commodity traders bought and sold large quantities of oil through international markets. Soybean oil and other vegetable oils were stored in large industrial tanks. These storage facilities were typically located near shipping ports and transportation hubs. The stored oil could then be shipped to food manufacturers and foreign buyers. Because commodity prices fluctuated, traders often held inventory while waiting for favorable market conditions. Holding inventory required significant capital. To finance these inventories, companies frequently relied on bank loans. Banks were willing to provide credit if the loans were secured by physical commodities. This type of lending is known as inventory-backed financing. In this system, the commodity itself serves as collateral for the loan. If the borrower fails to repay, the lender can sell the stored commodity. To make this process efficient, warehouse operators issued official storage receipts. These receipts confirmed that specific quantities of commodities were stored in tanks or warehouses. Banks treated these receipts as reliable documentation. Once a warehouse issued the receipt, lenders rarely inspected the inventory themselves. The system depended heavily on trust between warehouses, traders, and financial institutions. Commodity markets therefore relied on accurate storage reporting. If the reported inventory existed, the financial system functioned smoothly. Banks could confidently extend credit against physical goods. Trading firms could borrow money to expand their operations. As the vegetable oil market expanded in the early 1960s, the amount of inventory financing increased. Larger inventories meant larger loans. Commodity traders could scale their business by borrowing against stored oil. The more inventory reported, the more credit became available. This created strong incentives for companies to demonstrate large storage reserves. Financial institutions rarely measured the commodities themselves. Instead, they relied on documentation issued by warehouse operators. As long as those documents appeared legitimate, lending continued. The commodity trading system therefore functioned through layers of verification. Producers supplied the oil. Warehouses stored the inventory. Receipts documented the quantity. Banks financed the transactions. Under normal circumstances, the system worked effectively. However, the structure also created vulnerabilities. If warehouse records were inaccurate, lenders could unknowingly finance non-existent inventory. Because lenders rarely inspected tanks themselves, discrepancies could remain hidden. The entire system depended on physical verification. Without inspection, documentation alone could support large financial exposure. During the early 1960s, one company expanded rapidly within the vegetable oil trade. The company was called Allied Crude Vegetable Oil Company. It was led by a businessman named Tino Angelis. Angelis had previously worked in food distribution and commodity trading. He understood how inventory financing worked in agricultural markets. In 1962, Allied Crude began expanding its trading operations aggressively. The company purchased large quantities of vegetable oil from suppliers. These supplies were stored in massive industrial tanks. The tanks were located primarily at port facilities in New Jersey. From there, the oil could be shipped to food manufacturers and foreign buyers. To finance these inventories, Allied Crude borrowed money from banks. The company pledged stored oil as collateral for the loans. Warehouse operators issued receipts confirming the reported inventory levels. Banks accepted those receipts as proof that the oil existed. Because the receipts appeared legitimate, credit expanded quickly. Allied Crude used these loans to buy even more oil. The company therefore appeared to control large reserves of vegetable oil. This expansion attracted attention from major financial institutions. Large banks and trading firms began extending credit to Allied Crude. Some loans reached millions of dollars in value. The company's borrowing capacity increased as its reported inventory increased. More storage receipts meant more collateral. More collateral meant more loans. The company's growth therefore accelerated rapidly. To outside observers, Allied Crude appeared to be a successful commodity trader. Its storage tanks seemed full. Its warehouse documentation appeared reliable. Its financing arrangements followed normal commodity trading practices. Because the company handled large physical inventories, lenders viewed it as a legitimate borrower. The vegetable oil market itself was also expanding during this period. Rising demand made large inventories appear reasonable. Few lenders questioned whether the reported oil actually existed. As long as the documentation remained consistent, the system functioned. Angelis therefore continued expanding the company's borrowing. Each new loan allowed the company to report even larger inventories. This cycle reinforced the perception of rapid growth. Banks trusted the warehouse receipts. Traders trusted the company's reported storage levels. Financial institutions trusted the documentation. However, this trust created a critical vulnerability. The system assumed that reported inventory matched physical reality. If that assumption failed, the entire financing structure would collapse. Growth financed by trust scales quickly. Commodity trading during the early 1960s relied heavily on warehouse financing systems. In this structure, physical goods stored in warehouses could support bank loans. The borrower pledged the stored commodity as collateral. If the borrower defaulted, the lender could seize and sell the inventory. To simplify this process, warehouses issued official storage receipts. These documents confirmed that a specific quantity of goods was stored in a particular location. The receipts included details such as the commodity type, storage location, and quantity. Banks treated these receipts as reliable verification of inventory. Once a warehouse certified the goods, lenders usually did not perform their own inspections. The warehouse operator became the trusted intermediary. This system allowed banks to finance large commodity trades efficiently. A trader could store oil, receive a warehouse receipt, and present that receipt to a bank. The bank would then issue a loan based on the reported value of the inventory. The value of the collateral depended on both the quantity of oil and the current market price. If the market price increased, the collateral value increased as well. This meant that traders could sometimes borrow additional funds against the same inventory. The warehouse receipt therefore functioned almost like a financial instrument. It represented ownership of physical goods. In theory, the receipt guaranteed that the commodity existed. Banks relied on these receipts when evaluating credit risk. Because the system involved multiple institutions, each participant relied on the verification performed by another. Warehouses verified the inventory. Banks verified the financial documentation.
Commodity traders executed the transactions. Under normal conditions, this structure worked efficiently. Physical commodities provided tangible collateral. Documentation allowed banks to finance large volumes of trade. However, the system depended on the assumption that warehouse reports were accurate. If warehouse receipts misrepresented the quantity of goods stored, the collateral would be unreliable. In that situation, lenders could unknowingly extend credit against non-existent assets. This vulnerability was rarely tested because inspections were limited. Warehouse inspectors typically measured tanks from the surface level. If oil was visible at the top, inspectors assumed the tanks were filled with oil below. Detailed internal measurement was uncommon. Because the tanks were sealed containers, verifying their contents required more complex procedures. Those procedures were rarely used. Instead, inspectors relied on surface observations and documentation. Banks relied on the warehouse receipts. This chain of trust allowed large financial exposures to develop. Paper documentation replaced direct verification. Once lenders accepted the documentation, loans could expand rapidly. Paper replaced inspection.
Inside the storage tanks used by Allied Crude Vegetable Oil, a simple physical trick created the illusion of large inventories. Vegetable oil has a natural property that made this deception possible. Oil floats on water. If water fills most of a tank, a thin layer of oil can remain visible on the surface. From above, the tank appears to contain oil. In reality, most of the volume can be water. Allied Crude used this property to misrepresent its inventory. Many of the company's tanks contained large quantities of water. Only a small amount of vegetable oil floated on top. Inspectors examining the tanks often measured the oil level from the surface. Measurement rods were inserted through small openings in the tanks. When the rod touched the oil layer, inspectors recorded the depth as oil. However, the rods did not always detect the water beneath the surface. The measurement, therefore, appeared to confirm large oil reserves. Volume calculations were then based on these surface measurements. If the top layer appeared thick enough, inspectors assumed the tank contained oil throughout. This assumption allowed the reported inventory to increase dramatically. A tank that appeared full might contain only a fraction of the reported oil. Because oil floated on water, the illusion remained stable during inspections. The surface layer maintained the appearance of a full tank. Warehouse documentation then reflected these inflated quantities. Storage receipts confirmed the reported volumes. Banks accepted the receipts as proof of inventory. The financial system therefore relied on measurements that did not reflect the actual contents of the tanks. Over time, the reported oil inventory expanded. More tanks appeared to contain large quantities of valuable commodity. This allowed Allied Crude to secure additional loans. Lenders believed they were financing real inventory. The deception remained hidden because inspections were limited. Inspectors rarely drained tanks or measured the internal composition directly. Surface measurement appeared sufficient. As long as the thin oil layer remained intact, the illusion persisted. This simple physical trick supported millions of dollars in loans. The company could report enormous quantities of oil without storing the actual commodity. Documentation reinforced the illusion. Warehouse receipts confirmed the measurements. Financial institutions trusted the reports. However, the reported inventory depended entirely on the visual appearance of the tanks. Once deeper inspection occurred, the discrepancy would become obvious. Until that moment, the illusion remained intact. Appearance substituted for measurement. As Allied Crude Vegetable Oil expanded its borrowing, the company attracted attention from major lenders. Banks viewed the reported vegetable oil inventories as valuable collateral. Because vegetable oil was a widely traded commodity, it could theoretically be sold if a borrower defaulted. This made the loans appear relatively secure. Financial institutions therefore extended large credit lines to the company. The loans were structured around warehouse receipts confirming stored oil. Each receipt represented thousands of gallons of vegetable oil. When the reported inventory increased, the available collateral increased as well. Banks used this documentation to justify larger loans.
Several lenders participated in financing Allied Crude's operations. Among the most significant exposures involved a subsidiary of American Express. The subsidiary provided warehouse services that certified the stored oil. These certifications gave banks additional confidence in the collateral. Because a well-known financial institution was connected to the storage process, lenders assumed the verification was reliable. Credit, therefore, expanded rapidly. The company continued borrowing to finance additional trading activity. Reported inventories grew larger with each financing cycle. Banks competed to provide credit because the loans appeared well secured. As long as warehouse receipts confirmed the oil, the collateral seemed valid. The reported scale of the inventory became enormous. Millions of gallons of vegetable oil were recorded in storage tanks. These inventories supported loans worth tens of millions of dollars. For the early 1960s, these were very large financial exposures. The system depended entirely on the assumption that the oil existed. However, few lenders verified the tanks themselves. They relied on the documentation provided by warehouse operators. This reliance allowed the borrowing to expand without physical verification. More reported oil meant more collateral. More collateral meant more loans. The company's financial leverage therefore increased rapidly. At the same time, the actual inventory remained far smaller than reported. Because the tanks contained mostly water, the collateral was largely fictional. Yet the financial system continued functioning normally. Banks processed loans. Warehouse receipts circulated through financing arrangements. Commodity trades appeared legitimate on paper. The exposure spread across multiple financial institutions. If the inventory proved inaccurate, lenders would face large losses. But as long as the documentation remained unquestioned, the system continued operating. This created a dangerous feedback loop. Documentation supported credit. Credit supported expansion. Expansion reinforced the appearance of legitimacy. Collateral without verification multiplies leverage. By 1963, the reported vegetable oil inventories held by Allied Crude had reached extraordinary levels. Banks believed the company controlled massive reserves of commodity oil. Warehouse receipts confirmed these inventories across multiple storage tanks. However, some lenders began requesting additional verification of the collateral. The size of the loans had grown large enough to justify closer inspection. Auditors and inspectors were sent to review the storage facilities. Initial inspections focused on measurement procedures. Inspectors inserted measuring rods into the tanks. The rods detected oil at the surface. Surface readings appeared consistent with reported volumes. However, some measurements produced unusual results. The readings suggested inconsistencies between different tanks. Investigators began questioning whether the measurements accurately represented the contents. To confirm the data, deeper inspections were conducted. Some tanks were opened for closer examination. When inspectors tested the liquid beneath the surface layer, they discovered something unexpected. Most of the liquid inside the tanks was water. Only a thin layer of vegetable oil floated above it. The majority of the reported inventory simply did not exist. This discovery revealed that warehouse receipts had been issued based on misleading measurements. Banks had extended credit against inventory that was largely fictional. The discrepancy between reported and actual oil volumes was enormous. Millions of gallons of oil listed in documents were missing. Investigators began reviewing warehouse records and financing agreements. The scale of the deception quickly became clear. Allied Crude had borrowed large sums using collateral that did not exist. Once the discrepancy was discovered, lenders moved quickly to assess their exposure. Banks demanded repayment or additional collateral. However, the company could not provide the oil it had claimed to store. Without the reported inventory, the financing structure collapsed. The warehouse receipts lost their value as collateral. Loans that appeared secured suddenly became unsecured obligations. The financial system reacted immediately to the discovery. Credit lines were frozen. Investigations expanded across financial institutions. The discovery also triggered public scrutiny of the commodity storage system. Regulators and financial authorities began examining how the deception had occurred. The fraud had remained hidden because inspections were limited. Once physical verification occurred, the illusion disappeared. Reality overrides documentation.
The inventory fraud became public in late 1963. Financial markets reacted quickly. Banks began calculating the size of their exposure to Allied Crude Vegetable Oil. The reported inventories that had supported millions of dollars in loans were largely non-existent. This meant lenders were holding unsecured debt. Estimates suggested that losses could exceed $150 million. For the early 1960s, this represented a very large financial shock. Several major financial institutions had provided loans secured by warehouse receipts. Once the collateral was revealed to be fraudulent, those loans lost their protection. Creditors began competing to recover whatever assets remained. However, the company's remaining inventory was far smaller than reported. The available oil could not cover the outstanding loans. Financial institutions therefore faced substantial losses. One of the most visible impacts involved American Express. A subsidiary of American Express had issued warehouse receipts used in the financing arrangements. Because the subsidiary had certified the inventory, its reputation was immediately questioned. Investors reacted quickly in the stock market. American Express shares declined sharply as news of the scandal spread. The market interpreted the exposure as a potential threat to the company's financial stability. However, the losses represented only a portion of the company's total assets. Although the decline was dramatic, the company remained solvent. The broader financial community also began reassessing commodity warehouse financing. Banks realized that their collateral verification procedures had been inadequate. Warehouse receipts alone were no longer considered sufficient protection. Financial institutions began reviewing similar lending arrangements across commodity markets. The scandal also attracted significant attention in financial media. Newspapers reported how a simple physical deception had supported millions in loans. The story illustrated the vulnerability of systems that rely heavily on documentation. Commodity markets depend on trust between traders, warehouses, and lenders. When that trust fails, financing structures collapse quickly. The Great Salad Oil scandal became one of the largest commodity frauds in American financial history. It exposed weaknesses in inventory verification procedures. It also demonstrated how rapidly financial confidence can disappear. Institutions that had trusted the warehouse receipts were forced to absorb losses. Market participants began demanding stronger verification standards. Confidence that had built over several years disappeared in a matter of days. Confidence collapses faster than fraud builds. After the discovery of the missing oil inventory in 1963, investigators began examining the actions of Allied Crude Vegetable Oil and its leadership. Attention quickly focused on the company's founder, Anthony "Tino" Angelis. Angelis had directed the company's trading operations and borrowing strategy. Investigators reviewed financial records, warehouse documentation, and loan agreements. The evidence indicated that the company had misrepresented its inventory for an extended period. Banks had issued loans based on warehouse receipts that overstated the amount of oil in storage. Because these receipts supported millions of dollars in financing, the deception had significant financial consequences. Federal investigators began preparing criminal charges. The case focused on fraud related to false collateral and misleading financial documentation. Authorities argued that the company had knowingly borrowed money against non-existent assets. As the investigation progressed, prosecutors gathered testimony from warehouse employees and financial institutions. The evidence showed that the tanks did not contain the quantities of oil listed in official records. This discrepancy formed the basis of the criminal case. Angelis was charged with fraud related to the commodity financing scheme.
The case proceeded through the federal court system. During the trial, prosecutors explained how the water-filled tanks had created the illusion of large inventories. The court reviewed warehouse inspection procedures and financial transactions. Witnesses described how lenders relied on the storage receipts when issuing loans. These receipts had served as the primary form of collateral verification. Once the deception was exposed, the financial losses became clear. The legal proceedings focused on whether the misrepresentation had been intentional. Prosecutors argued that the company's leadership had knowingly created the illusion of inventory. The defense challenged aspects of the prosecution's interpretation of the events. However, the court ultimately determined that fraud had occurred. Angelis was convicted for his role in the scheme. The conviction confirmed that the company had obtained financing through false representations. The court imposed a prison sentence. The legal outcome reinforced the seriousness of financial fraud involving collateral. The case also demonstrated that criminal accountability could follow market failures. Although the financial damage had already occurred, the legal system addressed the misconduct afterward. The Great Salad Oil scandal remained an example of how documentation can be manipulated when verification procedures are weak. Fraud ends in court, not markets.
Among the institutions affected by the Great Salad Oil scandal, American Express attracted the most public attention. A subsidiary of American Express had been responsible for warehouse operations connected to the vegetable oil storage. This subsidiary issued warehouse receipts that confirmed the reported inventories. Banks relied on those receipts when providing loans to Allied Crude Vegetable Oil. When the inventory fraud was discovered in 1963, those receipts immediately lost credibility. Because American Express had been associated with the storage certification process, investors questioned the company's exposure. Financial markets reacted quickly. American Express shares declined sharply after news of the scandal spread. Investors feared that the company might face large financial liabilities. The decline in the share price reflected uncertainty about the scale of the losses. However, as more information became available, analysts began reassessing the situation. The company's total financial resources were far larger than the losses connected to the scandal. Although the exposure was significant, it did not threaten the company's survival. American Express therefore began addressing the financial impact directly. The company absorbed the losses associated with the warehouse subsidiary. Management communicated with investors to explain the scope of the problem. Over time, financial markets gained confidence that the company could withstand the shock. The share price gradually stabilized. The scandal remained damaging to the company's reputation in the short term. However, the institution continued operating its core financial services business. American Express maintained its position within the payments and financial services industry. In later years, the company would become one of the most recognized financial brands in the world. The incident therefore demonstrated that institutional resilience can follow major financial shocks. Although the scandal caused immediate losses and market volatility, the company's long-term operations continued. Investors eventually distinguished between the actions of the subsidiary and the broader corporation. The financial markets gradually moved beyond the crisis. The scandal nevertheless remained an important case study for risk management. Financial institutions reviewed how collateral verification procedures had failed. American Express itself strengthened internal oversight processes. The company's recovery also illustrated the difference between reputational damage and structural insolvency. A firm can experience severe reputational harm while remaining financially stable. The recovery of American Express became one of the most discussed outcomes of the scandal. It showed that large institutions sometimes survive events that initially appear catastrophic. However, the restoration of trust required time. Markets stabilize faster than reputations. Institutions can recover. Trust takes longer. After the Great Salad Oil scandal of 1963, financial institutions began re-examining how commodity collateral was verified. The fraud had revealed weaknesses in the warehouse financing system. Banks had relied heavily on documentation issued by warehouse operators. Those documents had been treated as sufficient proof of inventory. However, the scandal demonstrated that documentation alone could be misleading. Financial institutions therefore began changing their verification procedures. Lenders started requiring more direct inspection of stored commodities. Physical audits became more common in large commodity financing arrangements. Instead of relying solely on warehouse receipts, banks demanded independent verification. Inspection procedures were expanded to include deeper testing of storage tanks. In the case of liquid commodities, measurements began examining the full contents of tanks. Surface readings were no longer considered adequate verification. Banks also improved internal risk management processes. Loan committees required more detailed collateral reports. Institutions reviewed how warehouse operators certified stored commodities. New standards were introduced for measuring and documenting inventory. Financial institutions also diversified their exposure to commodity traders. Concentrating large loans in a single borrower was recognized as a major risk. After the scandal, lenders spread credit across multiple firms. This reduced the potential impact of fraud at any single company. Regulators also took interest in improving oversight of commodity storage systems. Government agencies examined how warehouse receipts were issued. Recommendations were made to improve documentation standards. Commodity exchanges and storage companies adopted stricter reporting practices. The goal was to prevent similar frauds from spreading through the financial system. Better inspection procedures reduced the likelihood of inflated inventory reports. Financial institutions learned that documentation must be supported by direct observation. Verification becomes mandatory after failure. The Great Salad Oil Scandal of 1963 remains one of the most instructive commodity frauds in financial history. The deception did not rely on complex financial instruments. Instead, it exploited weaknesses in verification procedures. Banks extended credit based on warehouse receipts. Those receipts represented stored vegetable oil that supposedly existed in storage tanks. Because the documentation appeared legitimate, lenders trusted the reported inventory. This trust allowed large financial exposures to develop. Allied Crude Vegetable Oil used those receipts to secure millions of dollars in loans. The company expanded its borrowing as the reported inventory increased. However, much of the inventory existed only on paper. The tanks that appeared to contain oil were largely filled with water. A thin layer of oil floating on the surface created the illusion of full storage tanks. Inspectors measuring only the surface level believed the tanks contained valuable commodities. This allowed the company to maintain the illusion for several years. Warehouse receipts confirmed the reported volumes. Banks accepted the documentation without deeper inspection. The financial system therefore treated the inventory as real collateral. When the tanks were finally examined more carefully in 1963, the illusion collapsed. The missing oil revealed that the collateral did not exist. Loans that appeared secure were suddenly unsecured. Financial institutions absorbed substantial losses. The scandal demonstrated how documentation can replace verification in complex financial systems. It also showed how quickly credit can expand when collateral appears reliable. Once the deception was discovered, the financial structure supporting the loans collapsed immediately. The scandal triggered investigations, legal consequences, and institutional reforms. Banks improved their inspection procedures. Warehouse operators strengthened reporting standards. Commodity markets introduced stronger verification practices. These reforms reduced the likelihood of similar frauds. However, the underlying lesson extended beyond commodity trading. Any financial system that relies on collateral must confirm that the asset actually exists. Documentation alone cannot guarantee the presence of real assets. Verification requires direct measurement and independent oversight. When verification is weak, financial systems become vulnerable to manipulation. The Great Salad Oil Scandal illustrated how a simple physical illusion could support millions in loans. The fraud succeeded because documentation replaced inspection.
When inspection finally occurred, the illusion disappeared. The scandal therefore remains a warning for financial institutions. Collateral must be verified. In finance, if the asset is not verified, it does not exist.